If you are not using Grok in pretty much everything that matters to you, then I think you're missing the boat. This morning, I had a lovely conversation with Grok about the stock market's capabilities of predicting the future in terms of the economy. It turns out that Grok overestimates or overpredicts when it comes to recessions. It's typically about 2 to 1. It'll have a dip like we had the dip in April. I'm guessing that that's not going to predict a recession. I'm pretty sure of that, in fact. And on the other side of the coin, the good news about the stock market is that it tends to not fail to predict recessions. So, yes, it's missed a few, maybe four since the Second World War, where there's been a recession and the stock market hasn't gone down. But for the most part, therefore, the stock market is very seemingly pretty darn good at predicting a rosy future. Now, the reason for that would make sense is you have millions of people making small bets on companies' earnings futures. They're not really betting on the market overall, except to the extent that you bet the indices or whatever. But you have lots and lots of highly professional people and average Joes making predictions on the earnings of huge number of companies which make up these indices. And therefore, if those companies are going to be, they're predicting profits and profits to be increasing in the future, then the market would go up and that would be predictive. So anyway, I thought that was interesting. Let's see, the markets this morning are slightly up. Continuing their upward momentum. And I think that's probably because they expect the Fed to definitely lower rates coming up here in a bit. Tesla is up again this morning. And I think that's somewhat to do with the Elon Musk pay package, but yeah, there's other reasons as well. Sawyer Merritt has this. Morgan Stanley's Adam Jonas on Tesla's new proposal to pay Elon $1 trillion. In our view, it's a good deal for Tesla shareholders. While the proof is in the execution, at face value, the proposed compensation package aligns Tesla's minority shareholder interest with those of Elon Musk. Yes, $1 trillion is a big number, but it's rather modest compared to the size of the market opportunity. We have entertained scenarios where the humanoid robot market can exceed the size of today's global labor market by a significant multiple, as has Cathie Wood, as has many others, including me. Contemporary future global GDP before contemplating future global GDP before taking into consideration AI robots is like contemplating global GDP before electricity. There you go. All right. Investing.com has this, though. Baird has reiterated its neutral rating on Tesla stock, maintaining a price target of 320. According to Investing Pro data, Tesla currently trades at a PE ratio of 191x. Significantly above industry averages. Yes, that would be true. The research firm's decision comes as Tesla's board unveiled a new compensation package. Tesla also released the next phase of its master plan. Baird expects both the incentive package and the master plan to be central topics of Tesla's upcoming shareholder meeting, where Tesla's Musk is likely to discuss long-term opportunities. Despite these developments, Baird maintains a cautious stance on Tesla in the near term, balancing the company's ambitious future plans against current market conditions. In other recent news, Tesla announced an update to its indemnification agreements for directors and executive officers as approved by its board of directors. This updated agreement ensures that Tesla will indemnify those individuals and advance expenses to the fullest extent allowed under Texas law. Additionally, Tesla's new compensation package for CEO Elon Musk, valued potentially at $1 trillion, has been a focal point, with Stifel reiterating its buy rating and maintaining a 440 price target for the company. William Blair, on the other hand, reiterated a market perform rating, noting that Musk's incentive plan underscores his long-term commitment to Tesla with an ambitious goal of reaching $8.5 trillion. As we know, Wedbush maintained its $500 target. And that's the list. That's the end of their list of people and what they've been saying since. CNBC has this: U.S. market share dropped. This is Tesla's U.S. market share dropped to a near 8-year low. Does anybody out there care what Tesla's automotive market share is? Let me know in the comments. As buyers chose electric vehicles from a growing stable of rivals, I'm so worried. This is all according to Cox Automotive. The decline highlights the threat from automakers ramping up EV incentives at a difficult time for the incentive. Analysts expect an EV sales bump to continue through September. Why would it continue only through September? Why wouldn't it continue into October, November, and December, given that you can place your order by the end of September? Sometimes these people just baffle me. Tesla, which once held more than 80% of the U.S. EV market, accounting for 38% of total EV sales in the United States, seeing its numbers falling below the 40% mark. These guys never took math. They never took statistics. They never took analysis. They just don't know how to think. Because I don't have to explain it to you guys, right? You watch Steve and Mark Ryan. You've heard it from me. If you have 100%, if you're 100% market share and another company sells one car, your market share drops. Much of Tesla's trillion-dollar valuation hangs on that bet. The company's board on Friday proposed an unprecedented $1 trillion pay package on things like robotaxi. For now, Tesla's core auto business remains its moneymaker. Yes, that's true for at least another quarter or two. Its last new model was the Cybertruck pickup that rolled out in 2023 with nothing of the success of its Model 3. Well, no, never. I mean, did anybody ever think it was going to sell the same as Model 3? Tesla has refreshed the Model Y, once the best-selling car, but the changes failed to live up to the expectation, and Tesla's on a track towards a second year of sales decline. No, not anymore. We're going to have a sales increase. Believe me, it's going to be a sales increase. Will it matter? A little bit, and it's nice, and it's lovely, but it doesn't really matter at this point. I know, this is according to Stephanie Valdez-Streety, Cox's Director of Industry Insights. I know they're positioning themselves as a robotics AI company, but when you're a car company, when you don't have new products, your share will start to decline. Cox has more complete data for July, when Tesla's market share fell to 42% from 48.7% in June. The drop was the sharpest since March of 2021. Okay, Musk's right-wing political work must be the reason. Sales of new EV. Okay, attractive offerings. For years, Tesla, as the market leader, was able to increase sales rapidly and command a premium price. Well, they were commanding a premium price mostly because of COVID and all that related stuff. But with weakening sales and a host of competitors, and with the end of COVID, of course, they're having to cut prices, but actually their margins have been going up recently. The falling share reveals Tesla's increasingly difficult choice of supporting sales using higher profit-destroying incentives for buyers, or maintaining profits and giving up market share. Tesla doesn't care about market share. The market share they care about is versus ICE vehicles, and I don't think they care about that anymore. The July data showed rivals outgrowing Tesla would be Hyundai and Honda and Kia and Toyota, as they go from 0 to 1. The Motley Fool says it this way. It says sales numbers have plummeted around the globe. Profitability is suffering. Its Cybertruck seems to be a dud, although it's the highest selling electric truck in the pickup truck in the United States. Its share price is more than 25% off of its highs. But those problems, and what were those highs caused by? Oh, yeah. But those problems are minor compared to my big worry, which could cause Tesla, the stock, and the company to tank permanently. Tesla's recently released Master Plan Part 4 practically ignores its core automotive business. Apart from a section on the company's auto-making history, the phrase electric vehicle only appears one time. The solar roof and battery storage businesses are also barely mentioned. Instead, the plan focuses on autonomous driving, artificial intelligence, AI, and humanoid robots. Yes, actually, I think that the fact that it didn't mention the batteries was an oversight. I'm kind of surprised by that. After the plan was released, CEO Elon Musk suggested about 80% of the company's future value could come from the line of autonomous humanoid robots. He's previously said that autonomous robots could give Tesla a $25 trillion valuation. Clearly, robotics and AI are what Musk is passionate about, you think? For Musk, it is not in selling his existing EV lineups. It is in developing No, it's in developing fully self-driving EVs or possibly even flying ones. No. His excitement around the Tesla Roadster redesign centers on how uncar-like it will be. In 2024, he said that Tesla's an AI robotics company as opposed to an electric car company. Right. He's been telling you this for how long? Before that, actually, I think. Of course, a working autonomous humanoid robot or a true self-driving taxi service would be a technological marvel, but none of the progress being made in these innovations, which are years away from deployment at least, will improve Tesla's slipping EV delivery numbers, stalled revenue growth, or tanking profitability. It's well written, at least. This will require the unglamorous, routine, boring work of running a car company, which Musk seems totally uninterested in doing. He's a bit like a dog that caught the electric car and now is looking for something new to chase. Well, that's not exactly right. What's exactly right is that Elon Musk now sees that it would be foolish to ramp up manufacturing of electric vehicles when vehicle manufacturing is going to drop like a rock due to cybercabs and robotaxis. You're only going to need to make about 20% as many vehicles total in 2029 as you're making now. That's according to Randy Kirk. Maybe it'll be 2030. Maybe it'll be 2031. But it's in the short term, not in the long term, that manufacturing vehicles is going to absolutely go completely off a cliff. Each robotaxi or cybercab or autonomous vehicle of any kind that takes people from point A to point B is going to be 5 times as efficient as a regular car. Therefore, unless you have people taking a lot more trips, you're only going to need 20% as much manufacturing of these new robo cars to get people to where they need to get. The proposed compensation package that was just released by Tesla board, if adopted, might encourage Musk to at least pay some attention to the core business. The EV-related operational milestone has 20 million vehicles delivered, but that 20 million vehicles delivered, by the way, which isn't mentioned in here, is including robotic cars, even those that go into the fleet. A further milestone would require 10 million active full self-driving subscriptions. Since that may not be possible for many of the Teslas already on the road, meeting the milestone would also require a big increase in EV sales. No, it would include those EV subscriptions on cars that are being used as robotaxis. Lastly, the package contained a series of adjusted earnings before interest, taxes, the EBITDA benchmarks, which would require Tesla to be bringing in more money than it spends on developing its new robotaxi and Optimus robot lines. Will this package be sweet enough to convince May to stay at Tesla? And if so, will it be enough to get him to focus on the critical yet unexciting work of rebuilding Texas core business? No, it will not, because that's not where they're going. Teslarati has this on SpaceX this morning. This is huge news. SpaceX has struck a deal with EchoStar to acquire 50 megahertz of exclusive S-band spectrum in the United States and global mobile satellite service licenses, paving the way for its next generation Starlink direct-to-cell constellation. The agreement strengthens Starlink's ability to expand its mobile coverage worldwide. With the upgraded system, SpaceX aims to deliver full 5G connectivity to unmodified cell phones and eliminate mobile dead zones worldwide. Starlink's direct-to-cell service was first launched in early 2024 with satellites designed to connect directly to standard LTE mobile devices. Within days of deployment, engineers demonstrated texting from unmodified phones, followed by video calling. Over the past 18 months, SpaceX has grown the system to more than 600 satellites, which now offer services across 5 continents. Today, Starlink Direct-to-Cell is considered the largest 4G coverage provider worldwide, connecting over 6 million users and counting, according to SpaceX in a post. The constellation integrates with Starlink's broader fleet of 8,000 satellites via a laser mesh network. So this is huge as they continue to expand their coverage. From Gwen Shotwell, we're so pleased to be doing this transaction with EchoStar. Okay, let's go on here. This is Randy Kirk, by the way. If you liked anything I've said so far, then hit the like button and hit subscribe. No matter what you're thinking about, you need to subscribe and then hit not notify. Later today, got Larry Goldberg, followed by Brian White. I'm sure those will be phenomenal. Market Watch. The downturn in U.S. jobs growth is actually a sign of an economy bottoming rather than deteriorating into a recession, according to Morgan Stanley stock market strategists. We are not of the view that a rapid, acute rise in the unemployment rate and or significantly negative payroll numbers are coming unless we were able to see another shock in the economy. We don't expect another shock in the economy. Therefore, they're not expecting the job numbers to continue to fall off. Non-farm payrolls rose a weaker than forecast 22,000 in August, but maybe that number is completely wrong, alongside a downward revision for June. Although an upward revision for July, the data appeared to seal the deal for a September Fed rate cut. Friday's jobs data improvement and revisions means June is the latest low point for payrolls this cycle, though other measures we track suggest labor weakness was mostly prevalent around Liberation Day, the trough of the rolling recession in our view, they said. And of course, the trough around Liberation Day would still be a Biden problem, which is going to be shown for what it really was on tomorrow at 10 o'clock, well, 7 o'clock our time. So I'll be reporting on it tomorrow morning when we see if they revise the job numbers for the 12 months, April to March, by 500,000 or a million. Wilson and his team have maintained that the U.S. recession began in 22 and bottomed on Liberation Day, and say the recent jobs data offers further proof the economy is now in the early stages of recovery. So this would be very much in line with Larry Goldberg's feeling that we've been in a recession for 2 years, and also but does not include Larry's impression that we're still in that recession. They're saying we're starting to climb out of it. The initial phase of this was led by tech and consumer goods, which benefited massively from COVID-related stimulus, followed by most sectors of the economy passing through individual recessions at their own pace. The rolling recession idea, though Larry thinks it was more of a real recession. This is a key reason why we never got the typical spike in the metrics used to define a traditional recession. A V-shaped rebound in earnings revisions breadth, a measure of analysts who have raised estimates minus those who have lowered them, also leads to recovery view. These types of inflections higher have only happened after recessions and not before, i.e. early cycle transitions. They added offering a chart. Investors are rattled by the latest job numbers should remember labor data are always late to the party, and by the time they confirm we are in a downturn, it's typically after the equity markets has already figured it out. To my point and Grok's point up above, they do see near-term risks for stocks surrounding whether the Federal Reserve can mount a big enough response, though. With the Fed still focused on the potential for inflation and the labor data weak, but not bad enough, there are questions in terms of just how much the Fed can cut in the near term, they said. Investors should see choppy markets into the weak seasonal October window, but any consolidation would set up a strong finish to the year of 2025, given our conviction for a durable and broad-based economic future. All right, Market Watch also had this. The idea is simple enough. Use actual economic data as it comes in to project what quarterly gross domestic product numbers would look like. No fewer than 3 of the Fed's regional central banks offer what they call nowcasts of GDP growth. The Atlanta Fed, the St. Louis Fed attempt to estimate the Commerce Department's preliminary GDP report, while the New York Fed model tries to estimate a later read on GDP called the advanced estimate. And right now, they're telling vastly different stories about the economy. In other words, put 3 PhD economists in a room, and you'll get 4 different opinions. And that's from data. The Atlanta Fed's nowcast is estimating 3%. St. Louis Fed's model, meanwhile, is estimating 0.6%. The gap is unusually wide. Calculations done by Google's Gemini find that after 2 months and a quarter, the average spread is 0.3%. with a standard deviation of 1.6 percentage points. But these numbers are exacerbated by volatility since the pandemic. Admittedly, the two nowcasts are taking different approaches to come up with their calculations. The Atlanta Fed model estimates each component of the GDP from incoming releases. The St. Louis Fed model, by contrast, takes a top-down approach and will use data that is excluded from GDP calculations, but has had value in the past in estimating economic growth. The New York Fed's nowcast is almost halfway at 2.1. I'll take a 2.1 for the third quarter. That'll be just fine. That the machines are confused perhaps should not be a surprise, as humans are always struggling to come to grips with what seems like contradictory trends. Payroll growth, for instance, has slowed down markedly while retail sales have been solid, said Randy Kirk 17 times last week. After the payroll data was released on Friday, U.S. stocks opened higher but closed the session lower. U.S. stocks were once again pointing higher on Monday, as I said a few moments ago. Inflation continues to show us a 1.98 reading for the overnights and a 1.91 reading for the year over year. So no changes really in those. I did not look up Trump's rating this morning. So sorry. I'll look it up for tomorrow for sure. Okay, let's see. We've got Tesla up 0.08%. We were up about a full percent earlier. Tesla's been coming down since the opening. And sitting, like I said, at 351.12, up 0.08 right now. We've got the NASDAQ still up 0.74 and very, very flat after starting up higher. And we got the S&P up 0.24, same thing, very, very flat. The Dow is actually climbing a little bit. It was negative, and it still is, but it's only negative 0.03 now. It is tending to go up. So Tesla is definitely going contrary to the market this morning. And looking like it might slide into the red. We'll see what happens as the day progresses. Apple is down a little tiny bit as well. And the rest of the Magnificent Seven are up, but and they're all over the place. There is not a trend to be found among the Magnificent Seven. The VIX this morning is at 1538. That is definitely risk on. And then the Cathie Woods are mostly up, with TDOC and 𝐶𝐲 down, and everything else is up. Oops, CRISPR just went into the negative. All right, let's go ahead and look at the bonds. The bonds are down 3.3 basis points at 4.053. I think we're looking at something with a 3 in front of it this week. This week we will be under 4%. That's my opinion. And I'm sticking to it. We've got oil up a little bit this morning, 0.34, because the OPEC number, the increase in production that they're planning, turns out that the analysts feel that it wasn't as big as they thought it was going to be. So you got a little bit of a bounce back on oil this morning. You got natural gas up 3.41% to 3.153. So natural gas moving higher. And gold moving higher, 3,669, up 0.44. That is not an all-time high, but it's very close. Silver up this morning, 0.58 at 41.80, very close to an all-time high. And copper up 0.18 at $4.51. And that would be very much exactly where it's been month after month. I mean, week after week now. It's been really in about a 15-cent trading pattern, up or down from 350. We've got the dollar down a little bit this morning. We've got Bitcoin up 1,500 at 112.7. We've got, that's it. That's all. Oh, I'm sorry. Ether is up 1.40 at 4,350 this morning, about the same as Bitcoin. All right, that's all I've got. So reminder, Larry Goldberg later tonight, around probably about 4 o'clock. Brian White at 7:45. And we've got last night, I did the weekly report very, very, very late. It's still extremely cogent. Everything I said last night is still right on. So I'll put that card right up there. And then Phil Beisel in the morning, as always, was amazing. You guys, a bunch of you watched it, but if you didn't watch it yet and you've got time today, I'll put that card up here as well. Very, very important information. You're not going to get anywhere else except right here, okay? Because of the way I ask Phil the questions. That's what's important. Is that Phil's intelligence? No, it's not the clever way he explains things. It's the way I ask the questions. You knew that, right? Oh, I think we'll go back and take a quick look at where Tesla is now. Tesla's actually well, no, it's up 0.09%. So still staying above the green, staying in the green, but not by much. Hey, it's been great talking to you.